afternoon. Thank you for joining us today for Journey's Q3 and operational update. Journey trades under the ticker symbol JOY on the Toronto Stock Exchange and JRNGF on the OTCQX. The company offers one of the best value propositions in the Canadian E&P space, with tremendous upside potential. After the presentation, there'll be an opportunity for Q&A. Please enter your questions in the Q&A box. With us today from the company is Alex Verge, CEO. And as always, the presentation may contain forward-looking statements. Welcome, Alex. I'll now turn it over to you.
Thank you very much, Jessica. And thank you for Adelaide to putting this presentation on. I'm very happy to talk to you all today. I think this is perhaps one of the best times in recent memory that I have where you can acquire our company at such a low valuation and with so much going on. And so I'm going to update you on the quarter. I'm going to update you on where we're at. I'm going to update you on some of the projects that we're at. I'm not using the corporate presentation in this. I'm using some slides from it, but I've also prepared a bunch of my own slides here to kind of highlight a little bit more about the assets and maybe go into a slightly deeper dive. So I am assuming that you're a little bit familiar with the story. If not, there's previous webinars and previous things that you can use to acquaint yourself with the story. But I'll start here with just the kind of things that I want to talk about today. I think that this is one of the most compelling times to own the stock. So these are the things that I want to talk about. Over the last 6 months or so, I mean, we've been under a lot of pressure on the commodity side of things, especially for natural gas in Canada here. I mean, we're pretty much at generational lows for the price of natural gas. And you know, the price of oil's recently started peeling off. But Journey itself is a different company. In the past, we would have been worried about these things, but we're different now. We have a much smaller balance sheet, a safer balance sheet. We have very supportive partners. I'm going to talk about all of this. We control our own destiny. The company is more sustainable. It's always had low decline and very predictable assets, but now with the emerging power business, we're going to have some cash flow coming in to offset our most significant operating cost, fuel and power. And I think the company is just a lot more sustainable. Obviously, the stock is trading at a low valuation. A lot of the energy patch is trading at a low valuation, largely because commodity prices are under pressure. That is going to recover. I referred to it on Twitter as a Black Friday sale. I mean, we're trading at 50% of our PDP. We'll sort of talk about our PDP. We'll spend a little bit of time talking about why I feel that the PDP is very solid, but there's a lot more than just the PDP to this story. So if we're cheap on a valuation level relative to PDP, it's really cheap compared to any other metric. We're all buying it. I bought stock. I probably put more than $400,000 into the stock of my own money since September. A number of our directors are buying it. A lot of our management team is buying it. So we're all buying. And you know, really the game changers are the things that, I mean, it has other things going for it that are going to help it get revalued. Things that are cheap and safe don't have. It is not a value trap because it has things that are going to help it get revalued. So key things here that we're going to talk about. We'll talk a little bit about the power business, but we're really going to talk a little bit more about the Medhap polymer flood, which is something that I haven't really talked about much in the past, and this emerging Duvernay play. And we're right in the middle of it. So we're going to be coming out of the Duvernay very soon. So this company has some of the best torque of any company in the space to rising commodity prices. But the company is safe enough to be able to weather the storm if commodity prices don't rise super quick. So let's take a look at, I mean, we bought out our bank syndicate in 2020. And then we kind of restructured the company a little bit in 2022 with a large acquisition from Enerplus in the fall of 2022. So since 2022, since we restructured the company at the end of 2022, in 2023, and so far to date in 2024, we've done a lot of things to position the company for 2025 and beyond. So just to summarize a few of the things that we've done here, we drove down our debt by more than 50 million. When we finished closing the acquisition at the end of 2022, we had over 100 million of debt. We've driven that debt down to about 51 million at the end of the third quarter, so we've taken 50 million off our debt. We've also termed out a really good chunk of that debt. We issued 38 million in convertible debentures. They pay an interest rate of 10.25%. They convert at $5 a share. And that basically terms out 38 million of that 51 million of debt that we had at the end of the quarter out till March of 2029.
And do you have the option to buy those out early?
We do after year 3, so that would be March of 2027. If the stock trades above 6.25 a share, we can buy them out earlier. We have also hedged about a third of our gas production for next year, starting January 1st to December 31st, so the full calendar year next year at 320 an MCF. So that's about 10,000 GJs a day. That hedge is currently, given the strip prices for next year, probably about $4 million in the money. We've restructured our AIMCO term debt. We've done this repeatedly from time to time as we needed funds or to counter the fact that our cash flow is a little bit lower because commodity prices are a bit lower. So we had a balloon payment that was due to AIMCO in October of this year that we kind of split out into a bunch of smaller payments. We wound up pushing our debt with AIMCO was supposed to be completely paid off by April 30th of next year. We've extended that date till basically August 30th of next year. So probably moving about, 8 or 9 million of debt kind of further out. So takes a little bit longer, but the company's under a lot less pressure and a lot less stress on a day-to-day basis by having that accommodation. So again, that's why I refer to AIMCO and some of our other debt providing partners as, really great supportive partners that have been part of the business and understand what we go through on a day-to-day basis. And they've been very, very supportive and accommodating.
And AIMCO, owns about 18%? Is that correct?
Yeah, they are our single largest shareholder. Yeah, just under 20% of the outstanding shares are owned by AIMCO. So they're sort of our primary debt provider, or they have been, and they're gradually transitioning to a long-term equity partner from a debt partner. So the other thing that we did is in our quarterly release, which came out on November the 7th, we alluded to a divestment. It was a divestment for relatively nominal value, but they were assets that had a lot of end-of-life costs. In addition, we've spent a number about $6 million here on end-of-life costs over the course of the year. So when we look at what we've done, we've reduced our asset retirement obligations by about $20 million in 2024. So again, ongoing focus of the company is to continue to focus on our end-of-life costs and our ARO. Also, as we move into 2025, in the spring of 2025, we hope to bring on one power project. Late in 2025, we hope to bring on a second one. So 2025 is a year where our power business turns from, we've been spending money on those projects in 22, 23, and 24, and we'll spend a bit more money in those projects in 25. I'll tell you how much that is, but by the end of 2025, that power business is going to turn into a revenue generating business rather than a capital consuming business. And that is going to help us go forward with free cash flow. And then last but not least, we've established this growth asset in the Duvernay, and I'll spend a lot of time talking about that today, but it's extremely exciting for us. And we've got good news right around the corner, I feel, on that, and I'll tell you about that too. So one of the themes that I want to leave you with today is that a lot of the things that are happening, lower cash flow means a little bit less money to plow back into the business right away. So that slows things down a bit. Delays on the regulatory side mean our power business take a little bit longer to get off the ground, but these are just delays. They're not lost opportunities. So everything is happening the way we said it was going to happen. It's just taking a little bit longer. So we do have, this is our guidance from August. We've recently, we're just updating our presentation right now for November. On November the 7th, we put out our quarterly release. We did reduce our guidance. What's really important here is to realize that, everything is performing the way it's supposed to perform. All of our capital projects are coming in the way we thought they would. All of these things are happening the way we estimated them or the way we forecasted them, but the commodity prices have been a little bit lower than we expected. So, I mean, you can look at our sensitivity chart here. You can see that we moved from kind of the $79 and $1.75 forecast that we had for the year to about $76, and I think we used $1.45. So, I mean, that's reduced our pricing. What I want to say about the leverage and the commodities is it works both ways. It can just as easily go the other way here at the end of the year and into the first quarter of next year as gas prices start to pick back up. I mean, I do not feel at all that gas prices are going to be in that $1.45 range for 2025. I think that was kind of a one-off. So leverage works both ways. I'm going to spend some time talking about our value proposition here. I'll start with the PDP, but then I'll start to go, into a little bit more depth on it. This is at the end of last year, so I'm going to speculate as to where we're going to be at the end of this year. But I mean, our PDP value per share, which is the produce-out value of our assets, was about $5 per share. That was $6.44 if we look at the P plus P producing, which is basically no capital, produce-out value of our assets with a slightly softer decline. You will notice that the PDP value dropped from 2022 to 2023. Again, we're not losing a lot of barrels. Things aren't performing differently. You can just see in 2022, $94 oil on average for the year versus $77 in 2023, $5.43 in MCF gas, $2.65 in 2023. And again, we're saying in 2024, we're going to be $1.45. So a lot of that reduction is just related not to the assets themselves, but to commodity prices, which do go up and down, and asset values do fluctuate up and down. But the important thing is that we've got a great asset base, and things aren't changing in terms of how our assets are performing or the stuff that we're doing. When we look to next year, where is that going to be? Prices are obviously a little bit lower for gas, but surprisingly enough, prices have come off for oil over what we were forecasting. But when you look at the long-term strip and the forward curve on oil, this backwardation was already baked in a reserve report. So what I've got here is a chart of the January 2024 three consultants average pricing in the dashed line, kind of the mustard colored dashed line. And then in the red line, I've got the October 24th price. This is for WCS. So Western Canada Select in the reserve report in Canadian dollars. To give you an example, our Medicine Hat and our Skiff properties, just over 2,000 barrels a day of our oil production, track Western Canada Select very closely. And you can see there in 2025, not much deviation. And then 2025 and beyond, those prices haven't really changed that much in the reserve report. So, 80% of our revenue in the reserve report is through oil and liquids. Less so for natural gas. So the reality is I still think that we're going to have, a very positive PDP in the reserve report at the end of the year. Maybe it's come off a little bit from $5, but to say that we're trading at 50% of our PDP value, I think is a fairly reasonable assumption.
And quickly, just to jump back to your reserve report and what and on your forecast, what are you using for exchange rate on FX?
I believe the exchange rate is about 0.74. And I think it probably, I mean, obviously it's forecasted over time. I'm not sure what the quarterly update on exchange rate is, but that was the one in last year. And this year, I think you might have a little bit of an upward bias in terms of pricing because that exchange rate might be just a little bit lower.
Yeah, because they follow the strip pretty closely. 71 cents right now. So that could add extra cash flow as well.
For sure.
As you're costs are lower and you're getting paid in US dollars, right? So.
For sure. And that's been a tremendous benefit for Canadian producers versus the US producers. So what I'm saying, okay, well, we're trading at this massive discount. Why are we trading at this massive discount? And why do we trade perhaps at a bigger discount than some of our peers? So let's start with why I think we're significantly undervalued. And there's probably a lot of reasons. I mean, obviously, we're very small. We're not on everybody's radar screen. We're not on any indexes. And, I mean, there's a lot of reasons. But one of the reasons here is that, in general, companies tend to trade at a multiple of cash flow. So let's just say, for example, all of the companies are trading at 3.5 times cash flow. Well, you may have one company where 3.5 times cash flow is only 50% of the PDP. Why? Because the production stream declines at such a low rate that you've got a constant cash flow stream well into the future, which when you discount back represents a lot of value. So our PDP may be 6 times our cash flow, but someone else who has a very high decline, a higher decline than the average, like a 35% decline, and they have a lot of new production, their PDP value may be only 2 times cash flow. So even though both companies trade at 3.5 or 4 times cash flow, one company may be trading at a discount to PDP, and another company may be trading at a premium to PDP. And that may be largely related to the decline. So you can see the journey on the top part of this chart. You can see that we are one of the lowest decline companies in the coverage universe. We estimate our current decline to be about 13%, and the peer average is about 29%. So that's one reason. And if I want to get further into that, why is our decline so low? And what is different about our asset base than some of the other asset bases out there? And, we built our company on these mature oil pools. It's not all brand new production. In fact, the assets have been so undercapitalized that the bulk of our production is not new. It's older. Here's an example of one of the assets we got at the end of 2022 from Enerplus. It's an Ante Creek asset. It's a Montney oil pool. You can see the reserve report price or the reserve report production forecast in that stair-stepping line. That's the reserve report forecast that we bought at the time that we bought the asset. And you can see on the right-hand side of that chart, for a period of time after we acquired, so we acquired this asset, basically we closed the deal on October 30th, 2022. So the first month is what you can see there. We were under forecast. So what happened here is that there were some failures early in 2022 on ESPs and pumps, and there were some maintenance issues, and Enerplus was selling the assets. The assets were in the market. They weren't spending a lot of money. So at the end of the day, none of this stuff got repaired, and we were a little bit underwater. But you can see what happened is that we were under till about the fall of 2023, and finally we have everything fixed and everything back on and everything repaired, and you can see the way the production's come up, and now we're producing more than we were even at the time that we bought it. And so here's an asset that was a declining asset, and we haven't drilled a well in that property. All we've done is plumbing, and all we've done is put some stuff back on, and all we've done is try to optimize the water flood, and you can see how well the property is doing. That is a testament to some of our assets. And we talk about, our development plan and our dollar per BOED additions, and here's how much money we spent, and here's how many barrels we wanted to add. But this is why this isn't the story. Here's an example in Skiff. We have about a 30 million barrel sawtooth oil pool down in southern Alberta. The northern part of the pool was developed primarily with vertical wells and then some horizontal wells, and we've been gradually developing the southern portion of the field and expanding the production of the south using horizontal wells and waterflood patterns where you drill 2 wells and then convert the middle one to an injector. But you can see what happens is the wells come on at a certain rate, and then you produce them for about 6 months and they decline right off because there isn't a lot of drive energy in the reservoir, and then all of a sudden you have to convert one to an injector. So by the time you hit month 12, you're kind of hating life and you're trying to figure out whether or not this is an economic project. And then sure enough, 24 months in, all of a sudden your water flood response is there and these wells are turning around, and you can see that most recent 9-5 pattern, how it's starting to increase in production, and then everything's right with the world. And so sometimes when you have these older mature pools, you have a lot of water flood assets, you have a lot of secondary recovery, you really have this, it's hard to just say, okay, well, this is how much have we spent, and this, you have to look at all of the different pieces to these. And the reserve report accurately tracks and captures a lot of this stuff, but it isn't really captured in a dollar per BOED statistic or something like that. So really stable, really long life, great quality base reserves. I'm going to spend a little bit more time now talking about kind of the wedge above that, the wedge between the on this chart on the right hand side, year-end 2023, between the 644 and the 1284. Some of that is our power revenue when these power projects are being built, but they're not on yet. When they come on, a portion of that, maybe $1 per share of that, will move down into the PDP category. But I really want to talk about our development plan, and a lot of that wedge is in infill drilling in existing water floods, water flood conversions, a lot of development of our existing fields. And we've got a fairly conservative booking on that. That'll be on the right-hand side where it's the percent booked in the reserve report. So one of the things that I want to highlight here is that that's a big wedge. And you look at it, it's about $6 a share, but that only represents about 40% of the projects that we have identified. And it doesn't represent, anything in the Duvernay. You can see that we haven't booked anything in the Duvernay. So what that wedge represents is the pie chart on the left-hand side. The booked projects, 274 million in capital. We have almost $1 billion in unbooked projects. And more than half of that is the Duvernay, but there are a lot of additional projects in these areas. So I'm going to talk about a couple of the game changers in the company here, being the Medicine Hat Polymer flood, which is largely, it's completely unbooked, and the Duvernay, and give you a feel for just how much is on the come here. So Medicine Hat, we do have upside booked to Medicine Hat in the reserve report. In fact, in that wedge that you saw, probably about $1 a share, about 60 million of value is booked to infill drilling and water flood work in Med Hat. But this year, if you've looked at some of our press releases, we've alluded to the fact that we're actually moving our polymer flood. Now, Enerplus had been polymer flooding this reservoir for years, but they'd only flooded those patterns that are shown in purple. This year, we've moved that to the orange patterns, and we're going to continue moving it. I just want to give you an idea of the size and scope of how large that can be. This is an example of a pattern that we injected water up to about 0.4 of a pore volume of water in that pattern, and then all of a sudden we switched to polymer flood. You can see that we're getting about a 10% increase in recovery factor for that pattern. Well, the Medicine Hat field is a very large field. It's got over 300 million barrels of oil in place that's currently developed. We've flooded about 20% of it. We can't flood all of it because some of it's in different areas, but from our existing blending facilities, there's some red lines on this map. Those red lines represent our current polymer injection system. You can see some plant in the symbols in there. We have a blending facility in the south and another one in the north. Those two blending facilities, to rebuild them today, would cost $65 million. The only thing we need to do to reflood or to flood the rest of that field, to basically increase our flooding of the field, is to build those orange lines and to convert new wells to polymer injection. So I know this is going to happen over many years and it's going to take a long time, But when you look at the size and scope of that, there's 175 million barrels of oil in place yet to be polymer flooded that can be flooded by these two blending facilities that are already built. And if we're looking at a 10% incremental recovery factor there, we're looking at about 17.5 million barrels. We have a 72% interest in that field. So that's where we're at on that. I'll move into the Duvernay because this is really the most exciting thing that we have happening in the company. In fact, we're at a point now where this is probably the most exciting thing that may have ever happened in this company. So we were an early mover in this play. We had farmed it out in the past. We had 3 basin leading wells drilled on our land. They're shown as the 3 blue horizontal wells inside that red box. One of the things, since we've been in this place so long, we had a really good understanding of the play. We had a really good understanding of the geology. We knew where the sweet spot was. So when you look at this play and you look at it on the broader macro level, you can see in the north, Baytex, they've drilled more than 40 wells on their land block. They're shown in the blue and the red there. And then down in the south on the fuchsia colored land, you can see Spartan Delta. Paramount. Paramount again drilled more than 30 wells in that land and consolidated a tremendous land block in there. You can see in the blue and the orange. Those wells are primarily drilled on azimuth. And then you can see the pink colored land in the middle, which is basically Spartan Delta's land block. And Spartan's Delta land block includes 70% of the lands in yellow. The lands in yellow are the joint venture lands that we have between us and Spartan Delta. Just for simplicity, let's just use maybe 30% interest for Journey and 70% interest for Spartan Delta on that block. Control over 100 sections on that block. Let's look at the size and scope of that block. But the one thing I want to leave you with on this chart is if you look at the trend, and that trend follows that reef trend, as you get closer to that reef trend, you get oilier, and we are in the liquid window on that trend. We're 30 to 40 meters thick, almost 40 meters in some spots, tremendous reservoir quality. The 2 wells that we were drilling this fall are shown in green on this map sheet, the Q4 2024 JV activity. What I will say is that both of those wells are now drilled. Both of those wells have been fracked. One of the wells has 74 fracks in it. The other well has 71. They both have about 3,600 meters of lateral length. We've injected about 1.8 tons per meter of sand. We are in the process of milling out the plugs, and then we'll be testing these wells. So the test data from these wells is going to be imminent. I don't know if people have had access or reviewed Spartan Delta's November 5th press release in their third quarter, but they highlighted a couple of wells to the north. In fact, you can see the edge of those wells just north of this red box. They highlighted a couple of wells in and around 1,300 barrels a day, 84% liquids. And then the other one, they had an operational issue, so it's a bit of a shorter well. But actually, if you grossed it up for length, it might even be better than the first well. So they highlighted some tremendous well tests, and you can see that our wells are on trend with that.
What were the rates in those wells?
Again, the one well was about 1,300 barrels a day. I believe Spartan said the first well had a 30-day peak production. So it was the best 30 days of production. At 1,394 BOEs a day, 82% liquids, 808 barrels of condensate, 329 barrels of NGLs, and 1.5 million a day of gas. The other one was only 2,450 meters of stimulated length versus 3,440 meters in the first well. So obviously that's maybe 2/3 of a well, but the production rate quoted on that well was 937 BOEs a day, and that was 92% liquids. So when you look at the type curve that we have for this well, the type curve that we have is shown in the bottom of that chart. That type curve is based on the average of the 3 wells that are on the block, but the technology has improved. I believe the way that we are completing these wells, we are going to get a better result than that. However, all of our economics and all of our development is based on that particular type curve. You can see that we've said between 11 and 13 million for capital. I believe that when it's all said and done, we've AFE'd these wells around $14 million, but I believe that they're going to come in between 12 and 12 and a half for drill and complete and tie in. So I believe we're going to be right in that range. I believe that that was based on about a 3,300 meter lateral. These are longer laterals. So I think these wells are going to be a little bit longer than those. And I'm hopeful that these wells are going to perform even better than that. So, like I say, we should, by the end of the year, we'll have considerable production data on these, and we'll be talking more about them. We're going to be drilling 8 to 9 wells with Spartan as our partner next year on this play. Again, our work and interest is in the neighborhood of around 30% on these wells and in this joint development. So, what could this be worth to us? We feel that there's enough land here that if we do the math and fully delineate the land, we're going to have 60 net locations. And you can see there's 60 net locations at arguably, $8 to $9 million a piece. And here's a map sheet of just what the 60 net locations would look like. And again, we're not counting locations on lands that we don't own or haven't accumulated yet. If we accumulate all of the lands and fill in all the holes, that there may even be more locations, but this is just basically net to our land. And how big could this be? Well, we said 400,000 barrels of oil recovery per well in our type curve, and 60 net locations is about 24, 25 million barrels of light oil, not even counting the gas and everything else. So when we look at this on a real macro level, and I'm pretty much winding down here, but when we look at this on a macro level, we have 17 million barrels of proven, developed, producing oil. What I've shown you is that we can add probably, well, if we look at our reserve report, just a softer decline on that alone takes us from our proven, developed producing to our proven and probable producing. That's 22 million barrels. The difference between the 22 million barrels and the 36 million barrels of oil is literally the 275 million of capital projects that we've got booked in the reserve report, the identified inventory. As I said, that represents about 40% of what we've identified. We've got an unbooked inventory, which is even bigger than that. So that's not even in that 36 million barrels. Then we also have 25 million barrels. That's net to us of potential in the Duvernay. And we've got a polymer expansion potential of 10 to 15 million barrels in Manhattan. So you're mapping out a plan that's somewhere today at 17 to 22 million barrels that's going to go somewhere towards 80 million barrels. And you're cheap based on the 17. So a tremendous future value inside the company. And these things are going to actually start to be valued in the company very soon as we talk about the Duvernay. And just one other slide that I put in here is just, even when all this is said and done, when you really look at how much oil we have in place and how much resource we have in place, and I'm just talking about the conventional now without the Duvernay, you can see that we're only looking at 15% total recovery. When I talk about what's booked in the reserve report, that's that 3% wedge between the 12% we've got to date and the 15% we ultimately think we're going to recover. So literally add another percent to that recovery and it's another 10 million barrels. So I'll just finish up with a brief update on the power. As everyone knows, it's been a painful process for us. The things that we can control, I believe that we're controlling. The things that we can't control in terms of the speed in which the regulatory bodies move and the speed in which we can, get connected to the grid, are things that we're trying to manage, but that has resulted in delays. Again, it's not lost opportunities. These things aren't costing twice as much as we thought they were going to cost. They're just taking longer to get onto the grid. This year, power prices have been low, so we really haven't lost that much. by the delays. We've got about $6 million left of capital to spend to get Gilby back on. That should come on sometime towards the end of the first quarter. Again, as we get closer and closer and closer to getting these things on, the number of things that can interrupt us and delay us gets reduced and reduced and reduced. So the confidence level we have that Gilby will be coming on very close to the end of the first quarter is fairly high. Again, it could slide a bit, but it's not going to slide a year, and it's not going to cost twice as much as we thought. It is going to come on. It is going to be what we said it was going to be. It's just taken us longer than we'd originally thought to get it onto and connected to the grid. But we will be ready by the end of the first quarter, and it should be on around that time frame. As far as sorry,
I just was jumping to Mazeppa, but go ahead.
Well, as far as Mazeppa is concerned, we don't have an ISD date yet. Again, we've been trying to get Mazeppa is a project that we bought for $5 million that would have cost more than $30 million to build. We bought it from the Orphan Well Association because it was a project that ran back in 2015. It was commissioned, it ran, it sold power to the grid. But all of the approvals have been lapsed because it's been shut in for 6 or 7 years because it was a Lexan project, and the AER shut down Lexan and took over their assets. So we had an opportunity to buy it. We bought it. We've been trying to get it turned on in place. We feel that we're just now moving into the phase 3 is what they call it. We've gone into the first phase cluster study. We've made our GWAC payment, which basically moves us into phase 3. We're hoping to get an ISD date soon. It'll probably be towards the end of next year, or very close to the end of 2025. Again, it's all built. It's sitting there. We may have to spend a little bit of money to get it on, reapplied for the grid connection. So we've got $6 million of capital to bring it on. It'll be tremendously economic once it comes on relative to the amount of money we spent and the amount of megawatts we have on stream. But really what I want to talk about is why we're doing this. This isn't a diversion from our existing base business, our Duvernay, our oil pools. I mean, that is our business. And we are focused on our business. The beauty of the power project is that because we have these assets that are low decline, but they're under secondary recovery, we circulate a lot of water. We use a lot of power for every barrel that we produce. We have a long life asset base, a very forgiving asset base, but we produce a lot. We use a lot of power in our mix in order to produce our barrels. So because of that, we wanted to find a way to offset the volatility that power prices were created. To put the volatility in perspective, in 1 month in 2022, our power bill was $500,000. In another month in 2022, our power bill approached $3 million. So, multiply that by 12, and if you've got $6 million of power 1 year and $30 million the next, it's very, very challenging to manage your way around that. So the way we have modeled this in our reserve report at the end of last year is basically the power revenues are shown on this chart in that mustard colored solid line as we forecast out into the future. And they're in the dashed line previous to that. So if these projects were both on or all on by the 21st in January of 2021, the revenue we would have received for power is shown in the dashed line. What we actually spent on fuel and power costs inside Journey is shown in the red line. And then moving forward, these are the forecasts in the reserve report. So long story short, if you haven't heard me explain this chart before, the simple thing that we're trying to do is we are trying to generate revenues from the sale of power. And those revenues are about $1 million to $1.5 million a month. And that's going to be us selling power to the grid. That's going to be the revenue for the power minus the cost of natural gas, minus the carbon tax, minus the maintenance cost. That's going to be the cash flow. So we're paying $1 million a month plus in fuel and power, and we're getting that back in revenue from selling power to the grid. And the beauty of that is about a $4 to $5 a barrel reduction in our effective operating costs and an increase in sustainability of the company. A lot of people have said this year, that the power business isn't very good and power prices are low. And, I just want to leave you with the fact that, we've seen generationally low AIMCO pricing this year. In my view, the price of power going forward is equal to the price of natural gas, because 70% of our power in Alberta is natural gas. It's probably even more than that on a day like today, where the sun really isn't shining, depending on the wind. I mean, it may be more than 80% of our power is coming from natural gas. And natural gas has been trading at such a generational low in terms of pricing. You can see that the pricing in the reserve report has come off a little bit year over year on natural gas, but you can also see, relative to the $1.45 that we're talking about this year in 2024, next year, the strip, the reserve report, everybody has prices much higher and growing from there. So the reality is, if you get out to 2026 and these things are both on running full time and the price of natural gas is $3.50 an MCF, I feel quite strongly that the price of power is going to be back on track and the value of these things is maintained. So I want to make sure that people do not, condemn a 20-year life cycle project for the price of power at a generational low over a 6-month period. So based on our forecast, when these things are all on, that's going to be about $90 million of value. And that $90 million of value is going to move from kind of the 2P value in our reserve report to the PDP value when these things come on. And we've got about $12 million left of capital to be spent to bring them both on in Mazeppa and in Gilby. So in conclusion, thanks for listening to me today. I'd love to answer your questions. I just want to leave you, what do I really want you to take away from this is that we've been talking about a lot of good things that are happening in the company since 2022. We've been talking about the Enerplus assets and the long life nature of those and how much they're helping us in our business and the future upside in giant pools like Mad Hat. We've been talking about our power business. We've been talking about our emerging Duvernay. Everything that we've said, everything that we forecast is happening. It's just that when you get slightly lower commodity prices, you wind up taking a little bit more time to get your balance sheet in shape, and that takes a little bit of money away from what you could pour back into the ground. These assets have all been undercapitalized, and over time they're all going to get the capital that they need. And this plan is going to come together. It's just been a little bit slower. And, the company is safe. Even given the reduced guidance, we're still under 1x debt to cash flow. And that debt is controlled by supportive partners. We control our own destiny. We operate our entire capital program outside of the Duvernay. And in the Duvernay, we've capped the expenditures on the Duvernay for 2024 and 2025. As we move into 2026, you still have a little bit of flexibility because you can always go penalty on a well here or there. When I say there's 60 net wells, that's about 200 gross wells. If you have 200 gross wells in a play and you want to go penalty on 1 or 2 of those wells, honestly, it's really not going to affect the ultimate value of that play. So we do have full control over our own destiny. We have low decline, very predictable assets. We've always had that. But with power revenue coming to offset our largest operating cost, which is fuel and power, that's making the company more sustainable. We have lower financing costs as we move into the future as well because of lower debt levels. So we have all of this going for us. It's safe. It's not going anywhere. Its value is there. But what it also has is these proven game changers. I've always said that the Duvernay has very little or no geological risk to it anymore. There's enough wells in that play. The sweet spots are mapped out enough. You know what you're going to get. The only issue that you have is execution. And I believe that we've done a really good job in picking Spartan Delta as our partner. The execution on these first 2 wells has been flawless. And as we talk more about the execution and what they've been able to do, I think you'll realize that, we've got a really great partner there. And Journey is in a much better position to have 30% of 100 sections with them as a partner than having 100% sections on our own and having to do this all on our own. This was the right way for a small company like us to develop and participate in the upside of this world-class play. And I think the execution has been flawless. I don't think the geological risk is significant at all. The sand's been placed. Now it's just up to the reservoir to deliver what we know it's going to deliver if you place the sand. So there's going to be good news coming from that. So it's cheap, and it's eventually, I think you're going to look back on the fall of 2024 and look at that as a buying opportunity and say, man, it was really cheap back then. I wish I'd bought it back then. So we're all buying it. We're in there with you. So thanks for your time and attention. And I'd love to answer a few questions if you have any questions.
Okay, well, thanks for that, Alex. Very fulsome rundown of a good chunk of your assets. Let's just go to the Duvernay for a minute. What were the costs on those wells? You said that about 11 to 13 million is your estimated cost. What did these wells
when they first AFE'd the wells, we AFE'd them for about 14 million. The key, like we've got 11 to 13 million there, but again, that was based on the 3 leading wells there and updating the cost to today. These wells are a little bit longer.
So I was just going to ask what the lateral length was.
Yes, the lateral length completed on these wells is about 3,600 meters. So that type curve might have been based on like 3,400 meters or 3,300 meters. Long story short, when they were AFE'd at about $14 million. And I believe they're going to come in closer to 12. We saved about $500,000 on the drilling. The drilling went well on both of the wells. More importantly than anything, we drilled them to the length that we wanted to drill them at. We stayed at the elevation in the reservoir we wanted to stay at. And we TD'd them where we wanted to TD them. So we had no issues getting the casing in, or we had no issues getting the wells drilled to length. Everything went smooth. So they came in about $500,000 under on the drilling. And right now it's difficult to tell in the completion because you need a little bit more time for all of the costs to be in. But we looked at where the costs were to date. We look at where we're forecasting, what we have left to spend, the mill outs, and I feel that, the completions themselves were AFE'd at about $8.5 million each, and they're going to come in about $7.5 million each. So we're going to be somewhere between $1.5 million to 2 million under that 14 million.
Okay.
And so that's going to basically, you can just put that right on the NPV.
Okay.
And I will say that those costs are also based on 2 wells per pad. And when you look to next year, it's unlikely we'll be drilling any more 2-well pads. I think we're getting to a point now that we'll be drilling, like this was licensed as an 8-well pad and those 2 wells were drilled. I think what you're going to see us drill from now on moving forward is 3 or 4 well pads. I think the difference is that in the completion, when you're using, if you've got 3 well, I think we had some benefits of drilling 2 wells and completing them both at the same time. There was clear benefits in the program, but those benefits are amplified even more if you go to 3 wells per pad. So I do feel that there's the potential to even drive those costs lower if things continue to go well.
Yeah, I was going to ask, I mean, initially people were talking 2 wells per section as far as the ideal completion, and now you think it's really 4 to 6, do you think is ideal?
No, I think we got to be a little, 2 wells per section does make sense. If I say we got 100 wells, 100 sections, I'm talking about 200 wells, 60 net wells. So the 2 wells per section makes sense. The thing that people are missing is that these wells are more than 2 miles each. So yes, you're drilling 4 wells in a section, but you're actually drilling 4 wells in 2 sections because each of the wells is 2 miles. So when I talk about 60 net locations, I talked about 60 net locations that are kind of longer than 2 miles. And when we talk about interwell distance, it varies between 250 meters and 380 or 400 meters. So depending on your interwell distance will be the number of wells per section. I think the play can be effectively drained by using an interwell distance somewhere around the 350 meter. I think 260 meters is too close. So given the kind of completions and the kind of wells we're doing, I think assuming 2 wells per net section is appropriate of these kind of wells.
Okay, I think you kind of alluded to this, but if we do have a longer downturn, do you significantly, at what price do you have to significantly pull back the capital program?
We're already there. If
You're
we
not
look
spending on
towards
anything but the Duvernay, basically.
if we look towards next year, I think that's probably where we're at. So the way it looked as though we were going to have trouble keeping up with the Duvernay. So the first thing that we did is we talked to AIMCO about taking that October payment and spreading it out over a longer period. So if we go out into next year and let's say we have $2.25 to $2.50 natural gas prices, even if that includes our hedge. And let's say we have $75 a barrel oil prices. We have probably enough easy, like we can meet our AIMCO obligations. We can spend 30 million on the Duvernay. We can do our end of life costs, but there isn't a ton of extra capital left over. I mean, push that up to $85 a barrel or $3.50 gas. And then all of a sudden you've got a lot of money that you can start to spend either doing more Duvernay or doing some of your conventional business. Okay. So I believe that that's where we're at.
Like at Med Hat, you can add about 8,000 of flowing, right?
Yeah, I do think that those are great projects. We control the pace of the development there. We don't control the pace of the development in the Duvernay. The problem that you have in the Duvernay is the logistics around water for the fracs. The best time to frac wells is probably in the spring, just after breakup, where you've got a lot of spring runoff. So the one thing that I would say is that there's a pretty good probability that the Duvernay program will be more or less front end loaded. And therefore, we'll probably be drilling aggressively in the first quarter and then right after breakup completing a bunch of wells. So you'll get that production on in August, which is great for cash flow and great for development and everything else. But we probably won't be doing a lot of our own projects until the fall. And again, all of that will be price dependent.
Okay, and what's your sensitivity to oil in 2025?
My sense of the oil price?
Oh, sorry, your cash flow sensitivity. So if you have a dollar change in WTI, what's your change in cash flow?
My assumption would be very similar to what you have in the corporate presentation and what I've included in this slide. And right in the bottom of that slide, in the sensitivity slide, is I'm assuming that the production mix is going to be pretty similar next year to this year. With the power revenue, say in 2026, a full year of power revenue, the sensitivity might be a little bit lower than that. But right now, $1 change US dollar per barrel is about a $2 million change in cash flow, and a 10-cent change in for natural gas is $1 million in cash flow. Beauty of it is it works both ways. It works in a rising commodity price environment the same way it works in the falling one.
Okay, great. And then for what's your estimated total recoverable barrel per well in the Duvernay?
Again, the type curve that I alluded to is based upon the 3 wells that are already there. The 3 wells that are already there produced over 200,000 barrels each. If you look at that type curve in the bottom, and then that type curve is summarized in the top. You've got, total reserves of 573,000 barrels, oil reserves of 400,000 barrels. And that's in that type curve. Like I say, we're saying the ultimate recovery on those wells is going to be about 400,000 barrels. If you look at that curve, that's where it plots out at. If you look at how far down that curve we already are, you can see that we have a high level of confidence that we're going to get that or more. Again, I feel that the new wells are going to be better than that. And why do I feel that way? Because we're using a slightly different completion technique in terms of where and how we're perforating these wells in between the stages. And I think we're going to get a little bit less height growth. I think in our first 3 wells, we probably pushed a lot of sand outside the Duvernay. I believe that all this sand's going to be in the Duvernay. I think we're going to blow this type curve away, but the proof will be in the pudding.
So, I mean, I guess you're not really giving forecasts yet for your production until you see what happens with these wells for next year, right? So
I think we need to see the capital program too. We need to know whether or not we're drilling 3 wells in the first quarter or 4 wells or more in the first quarter. And then we need to forecast when they're going to come on. I mean, our existing base is easy to forecast. It's just the impact of the capital program that's going to be challenging. And we don't have full detail from Spartan on how, I mean, they're obviously in there now looking at their own play. They're going to be drilling their own wells. They're going to be drilling some wells in the JV block. It's how they're going to space those all out. It's how they're going to get the logistics around the completion. The beauty of us tagging along on their program is I feel that collectively the sweet spot of the land is the JV block. So I feel that they're going to be putting a lot of emphasis on it. But because they're doing a much larger program, they're going to have the ability to, get services, get water, get all of the logistics out of the way. And to me, the only thing that is stopping this play from being a world-class play is logistics. And I think they've got that down in spades. So I really do feel that we did the right thing combining with them. But because we're combining with them, we kind of have to follow their timing.
Yeah. So you'll be front end loaded, obviously, on the production and
In the
the capital, and then second half you'll get the benefits. Once the power plants are approved and online, is it possible to add additional generation capacity in the future of those to those facilities? And thank you for the presentation.
Yes, thank you for listening and thanks for tuning in. And yes, look, here, as far as the power business goes, we can add another plant in Matswan. We can add another plant in Crystal. We've done some high-level studies to show that those are 2 areas where we could add. We could expand power facilities. If we were to expand a facility, the one we would try and expand is in Kaunas. We've tried in the past. There is a solar project that's taking up the space there. At the end of the day, that project has not been built. They've asked for an extension to 2026. By 2026, if they're not building that project, we could be expanding Kaunas. I think the reality is expanding, building new, it's the same process. My problem is that this process is really long. It's probably a 4-year process between saying, hey, I want to take Kaunas and move it from 5 to 10 megawatts. It might take me 4 or 5 years to do that. So you need a lot of lead time. You need, as it turns out, a lot of patience, perhaps more patience than we thought. You need to provide better guidance. And honestly, at this point, we've done what we wanted to do with the power. We've offset our fuel and power costs. I think the easiest thing to do is to add power in our existing fields to replace some of the generation that we have got. So I do feel that there's more to do on the power side, but we have nothing on the books right now, so I cannot promise anybody that we're going to have anything for another 3 or 4 years, because even if we started tomorrow, it's going to be a while. And we want to get these ones on. We want to
We're
see
going to have to crank things up in the province, really, as far as approvals on power. It's ridiculous.
It is ridiculous. And what is even more ridiculous to me is that it's almost the same approval process for a 15 megawatt facility as it is for a 150 megawatt facility. And, given that, it's, it does favor the bigger players. But we had a unique reason to add power to our mix. I think 5 years from now, we're going to be really happy we did, because when we have this crazy volatility in our power prices due to the amount of wind and solar that we have in the mix, and the
which
fluctuations,
contributes hardly anything. Yeah.
I agree, but when it's not contributing and we need the power, it's going to be based on natural gas. So in my view, I think there's going to be a lot of volatility, and I think the volatility is only going to get worse. And I think insulating ourselves from that volatility is going to give us a more predictable and more plannable future. So I support what we've done. I just don't think that we're going to be doing a lot more of it in the near term.
Okay, sounds good. And would you estimate the IRR on the 3 power plants around 20%? I mean, if you take out this year's power prices, it's hard to,
It's when you've got that kind of volatility. What I will tell you is that Countess is still pumping out revenue, and that thing is completely paid for itself. So, I mean, Countess has been on since 2020, and by the end of 2023, it paid for itself. So it paid for itself in 3 years. I would say the IRR on that is greater than 20%. I believe the IRR is higher than that, but again, it's all dependent on power prices, the price of carbon. One thing I will highlight that I never mentioned today, but it's a factor, is that, the price of carbon is a significant cost in these things moving forward. And it's fully forecasted in to our models. When we talk about PV values, the full price of carbon is forecasted in there. But as we know, we've got an election the end of 2025. And as these plants are on and we're going from 4 to 34 megawatts, we may have a regime change in Ottawa, and that may have a material, change in the way we look at the price of carbon. And if it does, it's going to have a material value increase to these projects and to the rate of return.
For sure. I mean, that will change a lot of things. One question: did you consider insulating pay from power volatility through hedges as opposed to selling into the grid?
You can. We do have some of our power fixed in terms of hedging, and we will probably continue to use that as a strategy until these plants come on, in terms of just kind of, capping your OPEX. But you definitely can do that. So, I mean, we've been building these things with surplus equipment, and we've been trying to get good deals on these things to bring them on. We think they're going to be highly economic. Where we kind of missed the boat a little bit maybe was on providing the right guidance. So the one thing is the capital is following. So when I said, Gilby's going to cost $20 million or $23 million or whatever that number is, I mean, it's not as though we spent all that capital and had to wait 5 years for it to come on. We're delaying the capital, and the capital is matching, the on stream date. So, I mean, it's taking a bit longer. That does negatively impact the rate of return a little bit, but it's just really not much different than what we thought it was going to be. So we're buying these things on a cost-effective basis. You can hedge, but you have to hedge multiple years in the future, and you have to give up stuff to hedge.
And that's, that could be a little bit dangerous too in itself, right? So
it's the same way as any hedge. I mean, you could have, like right now, you could go out and hedge natural gas for $1.90 next year, and if the gas is $3.50, you're hating life even more. So
that's right. So it's no different than the commodity. I don't want to spend too much time on the power, but are these approvals taking longer than your first project?
Yes, materially. And the cluster study, that the new way that they're approving these projects has basically taken the existing ridiculous approval times and doubled them all. Yes, okay. A ridiculous amount of time.
Yeah. Okay. And do you think if you had partnered with a data center provider, which I don't, anyway, to let them take, would that have been better for them to deal with the bureaucracy versus you, or would you still have had to deal with it as a producer of the power, even if they were a purchaser of your power?
I can't speak to, data centers or Bitcoins or the economics of all that and what they're planning on doing. The one thing that I can tell you is that 15 megawatts is a pretty small power project in the
it's not big enough for most data centers.
Data centers, they're 100, 200, 300. I mean, guys are buying 3 Mile Island for a data center. I mean, it's a completely different level and a more commercial level. We're trying to offset operating costs. So we're not on that scale. This isn't a business. This is just sort of a sustainability measure. So if we had combined with them, that would be great. We would be selling them power and perhaps not being on the grid. If you're doing that, that's probably going to simplify the process considerably. You're going to be removed from all of that. You can do whatever you want in your own land. You can generate all the power you want with natural gas and you can sell it to the guy next door. That's all easy to do. But some of these data centers are going to be large, and some of these data centers are going to want backup power in the event that power fails, and they may want to connect to the grid. As soon as you say, hey, I want to connect to the grid, that's when I think
the majority of them are going to have their own grids and their own natural gas supply, and that's the way it's going to work.
And as long as the gas supply is redundant, as long as they have more than they need, so if units go down, other units come in and take over, then I think they're great to run off the grid. And if they're running off the grid, then that's going to work great for them.
Yeah, but most of them aren't running, like in the US. They're getting pushed off the grid already. So, especially for the predictive AI. So, because that's about 10 times the amount of power you need. So we'll move on from that. Hedging strategy. Well, you don't really hedge. You didn't hedge this year. So, except for the gas for next year. Anything else?
Well, the gas is in contango. So there's a lot of logic around hedging gas. So would we look to do more of that? Yes. We hedged 10,000 GJs a day. The offsetting buyer of that was Suncor. Could we have hedged 20 or 30,000 GJs a day? Not really, because we don't really have a bank line and haven't since 2020. So usually you have a large bank line and then you can do all the financial hedging on the other side. This is a physical hedge. Similarly, we have oil that's produced at a bunch of different spots through a bunch of different marketers. So we can't go out there and use all of the financial instruments to hedge oil or to hedge natural gas, because in order to do that, we would need a bank line or we would need to put up security. So over time, as the company gets bigger, as we get free cash flow from the Duvernay, as the company becomes larger, and as our debt levels are lower and lower and lower, we'll be able to put up security and we'll be able to do more hedging. But that's been one of the issues. And of course, the other issue is that if we needed to hedge to protect our business, that's one thing, but the
You
oil
don't really
curve
need
is
to.
strongly backwardated. So
Yeah.
if I went to hedge right now for 2028, I'd be hedging at $64 a barrel. I don't see why I would do that
Not
unless
unless you
there
had
was
to.
a risk to my business. And
Yeah.
if my debt levels are so low, I think you're better off running with less debt and protecting the company that way than hedging into a backwardated market.
Yeah, that makes no sense unless you have to do it for that's the nice thing about not having a bank line, else you would be forced to hedge potentially right now. And so okay, so we've got a few questions on the end. So assuming energy prices stay flat for the next year, at what point do you think you'll have free cash flow to begin buying back shares under the NCIB? Is Q3 a good estimate after AIMCO is paid back and the Gilby plant is up and running?
That's a great question. $75 a barrel and call it 250 an MCF. And I think you're gonna have a pretty good balance between being able to pay the Duvernay, being able to pay down your debt by the end of August, and then you're right as you move forward from there. But I don't want to say that I don't want to use the NCIB because I do. I'm in here buying stock myself today, yesterday, last month, the month before that. I mean, if I'm buying the stock in the marketplace, obviously I think there's a great use of proceeds. We can talk about what you want about the NCIB, but clearly at the current price, it would rival in terms of use of capital our existing domestic, like our other programs. So yes, it's interesting to do that. But what I'll caution you on is we've capped Spartan Delta and the total joint venture capital in 2024. We've capped it in 2025. So we get out to middle of 2025. We spent most of our money on the joint venture. We've drilled 8 or so wells. We've completed them all. They're all on production. But then we got to start looking to 2026. And the caps aren't the same as in 2026. So what if we anticipate we want to drill 16 in 2026? Well, we might have to start saving money for that in 2025. So I would love to say, yes, you're correct. That is the right timing. That is when we should be able to do that. And we should be able to use our shares, our money to buy back some shares at that point. But number one, I have no idea where the shares are trading. I really don't have a handle on what commodity prices are going to be next year. And I have no feedback as to what kind of money I'm going to need for 2026 and what the phasing of that capital is going to be. If we decide that we're going to drill 16 wells in the first half of 2026, I'm going to need $60 million net to Journey for that.
Yeah, I mean, in some cases, it would make more sense to buy back your stock, but I mean, you're spending money to build up for bigger projects, so it's more of a growth area. Just on we're running quite long here, so probably should tie it up pretty quick. Thanks for the presentation, Alex. Do you have any strong feelings towards AIMCO leadership change, and if that board and CEO, and if that impacts you?
It's a good question. Thank you for that. Like everybody else, I kind of read it in a press release, but probably unlike anybody else, I immediately started, emailing and trying to figure out what was going on. And, I'll tell you that I don't think it's going to have any impact on Journey. And that's really the extent to which I could tell you. I mean, Journey's file at AIMCO is being managed by a person who is largely doing business here in Alberta, has outsized returns relative to the rest of AIMCO, and is actually what AIMCO wants more of and not what AIMCO wants less of, or what the government wants more of and not less of. So I would say that we're in a good spot within that organization. That group is doing outsized rates of return. That group is doing work mostly in Alberta. That group isn't a cost factor. issue like the other groups. So all of the things that they're trying to improve upon are things that this group is already doing. So this group is a sweet spot inside AIMCO. So this is not going to affect Journey at all.
Okay. And then have you been approached by anyone given your low valuation as far as takeout? Which you probably are not going to be able to comment on anyway.
I really can't.
Yeah. And then last but not least, besides AIMCO, how has your shareholder base evolved over the past year? Breakdown between institutional versus individuals, any significant shareholder in the stock? I can probably answer that. I think we've seen some, given the oil tape and the amount of money that's flown has left the oil and gas sector is unbelievable, both in Canada and the US, but particularly in Canada. So I think we've had two of your major shareholders probably get out of the stock. Would you say that?
Yeah, I mean, I honestly, I don't know for a fact who's in and who's out or what's happened. What I do know is that starting kind of in the fall of last year, commodity prices tended to roll over, and throughout the course of the year, they've been kind of
we've had a couple
on a downward trend, and especially on natural gas. And at the end of the day, what I would say is that we had a really good multiple coming off the Enerplus acquisition, 2022. You know, we have so much torque to rising commodity prices. When you have a period like we had in 2022, the positive uplift for Journey was so huge, and it will be again if that happens again, that you tend to get a huge influx of capital into the stock. And there was some momentum players in the story. And I believe that maybe those momentum players in the course of, the last year have kind of come out. So I think value players are there, but
it's not just out of your stock, it's out of everybody's stock. Okay,
that's correct.
Like we have had record level outflows of capital, and then it's the worst performing sector is going. So, I mean,
it seems to be consolidating well in and around the current level.
Yeah. So, I mean, I've started to see some contrarians come back in to the space, or some people are who are more energy oriented investors are long and waiting for the recovery. But in the meantime, I'd say you and like everyone else has not had a real increase in institutional ownership whatsoever. I mean, they've been sticking up market for the majority of the last year for sure. And like you said, like the incremental fund money that was in the space has come out, and it's but hopefully this is the close to the bottom, and then maybe we'll see some improvement from here.
Well, at the end of the day, you've got to kind of ask yourself, how can you weather this downturn, and what do you need to do to weather the downturn? And we definitely have the ability to weather that downturn. And the longer this is, the slower the ramp up is on the other side. And I get all that. But at the end of the day, the ramp up still occurs. So it's really not a question of, whether or not the company is going to recover and whether or not the company is going to profit and whether or not all the things that we say that are going to happen are going to happen. It's just more a question of when and how long it's going to take and how fast it's going to ramp up. And those are things that are outside of our control. But the things that are in our control, like protecting the balance sheet, going out and getting this key Duvernay land and then finding the right way to exploit it by choosing the right partner and eventually sticking with it on these power plants and bringing them on. All the things that we can control, we're controlling. The things that we can't control, we're mitigating against so that the company's safe.
Okay, great. Well, let's tie it up there because we've gone a bit over time. If anyone wants to replay, you can just email me. And are these slides available, Alex, if someone wants a copy of them?
I don't think these particular slides are going to be up on our website. A lot of them are already in the corporate presentation. So I think they'll be able to see the slides in the replay of the webinar. I guess it'd probably be the best way to do that, to just replay the webinar and stop it and see the slide.
Okay. All right. Super. Well, thanks everyone for your time this afternoon. And look, if you have any questions, again, email me at jessica@adcap.ca. Thank you.
Thanks, everybody.